Hey everyone, and welcome back to the channel. You've probably seen the headlines. You've heard the whispers. Bitcoin to $200,000 by the end of 2025. It's a number that gets the blood pumping for every crypto investor, a dream target that promises life-changing gains. The online forums are buzzing. The crypto Twitter accounts are in a frenzy. The bull run is on, and everyone's strapped in for the ride to the moon. But here's the thing. As we stand here in late 2025, with Bitcoin hovering around the $110,000, $120,000 mark, we have to ask a serious question. Is that $200,000 target really a realistic goal, or is it just another piece of speculative hype? Today, we're going to do something that most of the crypto community isn't doing. We're going to pump the brakes. We're going to take a cold, hard look at the data, the trends, and the fundamental market realities to debunk the $200,000 hype and give you a more grounded, and frankly, more useful, perspective on where Bitcoin is really heading. First, let's acknowledge the arguments for the bull case. Because they're not entirely without merit. The biggest driver of the current bull market, without a doubt, was the confluence of two massive events in 2024, the approval of the first spot Bitcoin ETFs in the US and the fourth Bitcoin halving. The ETFs, spearheaded by giants like BlackRock and Fidelity, were a game changer. For the first time, institutional money and traditional retail investors could gain exposure to Bitcoin without dealing with the complexities of crypto wallets, private keys, and exchanges. We saw billions of dollars in inflows almost overnight. This brought a level of legitimacy and liquidity to the market that was unprecedented. It was a massive psychological and financial boost. Then you have the halving. As you know, the halving cuts the reward for mining new Bitcoin in half. This is a deflationary mechanism hard-coded into Bitcoin's protocol. In simple terms, it reduces the supply of new Bitcoin entering the market. In the past, every halving has been followed by a significant bull run, as reduced supply met growing demand. The thinking was, and still is, that 2024 would be no different. The combination of massive institutional demand from the ETFs and the constrained supply from the halving seemed like a perfect storm for a price explosion. And for a while, it was. We saw Bitcoin soar well past its previous all-time highs, reaching a new peak somewhere in the low to mid $120,000s in the first half of 2025. This rapid ascent fueled the narrative that the price would just keep going up, and up, and up. It led to those bold, six-figure predictions. The $200,000 target, for many, wasn't a question of if, but when. But now, let's introduce a dose of reality. The market, as always, is far more complex than a simple supply and demand narrative. The past few months of 2025 have shown us that. While the price has been resilient and is holding strong well above the pre-halving levels, it hasn't maintained that parabolic trajectory. In fact, we've seen significant periods of consolidation and even sharp pullbacks. So, what's holding it back from that magical $200,000 number? Reason number 1, macroeconomic headwinds. The global economic climate isn't exactly a smooth sailing. We've seen persistent inflation, rising interest rates in some economies, and ongoing geopolitical tensions. In times of uncertainty, traditional financial markets get jittery, and so does crypto. Bitcoin, despite its digital gold narrative, has shown a strong correlation with risk on assets like tech stocks. When the broader market pulls back, Bitcoin often follows. A major recession, an unexpected geopolitical crisis, or a sudden change in central bank policy could easily derail the current momentum and trigger a much deeper correction. The idea that Bitcoin is a completely uncorrelated asset is, at this point, a myth. Reason number 2, regulatory uncertainty. Yes, the US approved spot ETFs, which was a huge step. But the regulatory landscape is far from settled. Governments and regulatory bodies around the world are still grappling with how to classify and regulate cryptocurrencies. We've seen a joint push by the US and UK to align regulations, which could be a positive long-term step, but it also means more oversight and potentially more restrictive rules. Remember the proposed repeal of Staff Accounting Bulletin 121, SAB 121, and the introduction of ASC 350/60. These accounting changes, while intended to bring clarity, show that the legal and financial frameworks are still very much in flux. A sudden, unfavorable regulatory decision in a major economy could cause a significant sell-off. Reason number 3, the rise of the altcoins. For a long time, Bitcoin's dominance was unquestioned. It was the entry point for most new money. But that is changing. We are currently in what many are calling a sustained altcoin season. While Bitcoin has been consolidating, we've seen explosive growth in other areas of the crypto market. Ethereum, Solana, and other Layer 1 protocols are gaining traction. The AI crypto narrative, with AI agents and related tokens, is a massive new trend. The total crypto market cap has reached record highs, but a significant portion of that growth isn't just going into Bitcoin. It's flowing into DeFi, NFTs, and a whole new class of DAPP tokens. This capital rotation means that Bitcoin isn't soaking up all the available liquidity like it used to. Its dominance is being challenged, which naturally slows its parabolic price growth. Reason number 4, diminishing returns and market maturation. The halving narrative is powerful, but we have to consider the law of diminishing returns. The first halvings had a massive impact because the market was so small. When the supply cut was from 50 BTC to 25 BTC per block, it was a huge proportional shock to the system. Now, the halving cuts the supply from 3.125 BTC to 1.5625 BTC. While still significant, the overall market is a $1 trillion ecosystem with billions of dollars in daily trading volume. The impact of the supply shock is diluted. The market is maturing, becoming more efficient, and perhaps less prone to those explosive, once-in-a-lifetime price surges we saw in the early days. Look, I'm not saying Bitcoin is a bad investment. Far from it. As we've seen, it has shown incredible resilience. Institutional adoption is real, and the digital gold narrative continues to attract investors seeking a hedge against monetary policy uncertainty. Bitcoin has performed extremely well in 2025, and it has cemented its position as a legitimate hard asset, outperforming many traditional investments. But the point is this: the idea of a straight, frictionless line to $200,000 by the end of the year ignores the significant hurdles and complexities of a maturing and increasingly competitive market. It ignores the very real possibility of macroeconomic shocks, new regulatory frameworks, and the natural ebb and flow of capital between different sectors of the crypto world. The $200,000 hype, while exciting, is a distraction. It's the kind of short-term thinking that leads to poor investment decisions. It encourages you to FOMO in at the top and panic sell at the first sign of a correction. A more realistic and healthier perspective is to view Bitcoin's journey not as a moonshot, but as a more measured climb. We should be focused on the long-term fundamentals, the continued institutional adoption, the expanding network, and its role as a decentralized, global store of value.